Good evening. Today is Monday, February 22nd. S&P 500 fell for a fifth straight trading session, its longest losing streak since February of last year. The sell-off started overnight after failing at 39.15 level. It then tested the round number 3900 a few times, failed again, and we closed down around 25 points at 39.77. Nasdaq was the weakest today, down around 350 points or over 2.5%. The Tesla even sold off. It was down 8%. Investors, I guess, got scared by bonds making new lows again. And Yellen's comments didn't help much. She was saying that financial transaction tax is worth looking into. And also Powell is going to testify this week, so that should be interesting. Crypto had a roller coaster day today. Again, Yellen said that Bitcoin is extremely inefficient for conducting transactions and is a highly speculative asset. So that scared crypto holders, but not for long. Bitcoin sold off over 10,000 from the high of 57 to the low of 47, but just as quickly recovered 6,000, and it's now trading around 54,000. The 1 trillion market cap was defended. And Ethereum also collapsed intraday in sympathy, but also quickly bounced back. It has dropped from 1950 to 1650, and it's now trading around 1800. So during that Ethereum move, the cryptocurrency exchange Binance has temporarily suspended withdrawals of Ethereum and Ethereum-based tokens due to allegedly high network congestion. So if just an hour sell-off could cause this, I wonder what will happen if it's a little longer than that. Bloomberg Commodities Spot Index rose to the highest level since 2013. As oil was up 4% and lumber also made new highs. And of course, Mr. Burry from the Big Short keeps tweeting about hyperinflation in Germany still. And meanwhile, our corporations are turning woke one at a time. Coca-Cola now trains its workers to be, and I quote, less white. Apparently, it's part of a learning plan to help build an inclusive workplace. And our famous Dr. Fauci said that, of course, we need to keep wearing masks even after vaccination. We need to keep social distancing and wearing masks. So they keep moving the goalpost, and it's very unclear when we will be allowed to function as a normal society again. Victor, what do you make of today's sell-off?
Well, that was a very good review of what happened. I paid a lot of attention to the Nikkei today. It pretended to go below 30,000, then went up to 32,000, and then at the end of the day was back to 30,000. The bonds were at 162.5, 80-day low. We've had possibly 5 down days. There was one day that was sort of unchanged, but certainly on the 2-day, we've had 5 down 2 days. But the SPUs are up from 37.50 at the end of 2020. They're up, say, 3%. The Nasdaq is up 2% or 1%, and crude is way up. It's up about 25%. The euro is unchanged. The Nikkei is up 10% so far this year. So with all the declines, we're still up considerably. Now we've been 5 days since 20-day high. the bull market is still intact. I got a interesting review from the New York Post that's talking about home road splits, and they're saying not every team has been affected the same. For instance, Duke has been affected greatly as its young players joined the program with dreams of playing in front of the raucous Cameron Craft. My daughter and her husband are part of that Cameron Classics. They have to camp out for 3 days on a weekend to get tickets for that. But now no one's watching it. Can't watch it. Why can't they watch it? It's part of the woke thing. But then they say there are certain teams that do a lot better on home than on the road. The top 10 teams with better true home court performances are Minnesota, UC Irvine, Furman, Vermont. The top 10 teams with better true road court performance, Bowling Green, Morgan State, Wisconsin, New Mexico. All right, so that they're actually calculating binary splits of home versus road. I thought that we should try some binary splits on the stock market. You can actually bet on this on in London. The bookies will take. I base this on the last 260 observations. The last actually 500 observations since the beginning of 2019. When the euro was up, then the chances that the S&P would be up the next day is 57%. Now here's something interesting. People, you're always asking what happens when there's a red day like there was today with both stocks and bonds down. Well, come back to the red days. When the S&P is down the previous day, chances that it will be up the next day is 53%. When the bonds are up the previous day, the chances that the S&P will be up is the next day is 59%. When the bonds are down, chances that the S&P will be up is 55%. Okay, now here's on our red day, which we've had 3 red days in a row, but there were 65 red days since 2019. What are the chances that the S&P will be up the next day? 66%. Of course, you have to look at the expectations also. Actually, the chances, the expectation that the S&P would be up, it's up on average up 10 points the next day. Now, if bonds down and S&P up, I think that's a yellow day.
Mhm.
The chances that the S&P will be up is only 51%. So that's relatively bad with bonds down and S&P up. With bonds up and S&P down, the chances that the S&P will be up the next day is 61%. the expectation is 0 though. So even though it's the probability is inordinately high, above 60%. It's 55% for any days. Now with crude up the previous day, has no effect. The stock market is up 56% of the time. With crude down, stock market's up 58% of the time. The most useful thing now is to talk about the kind of habitat that we're in. We're in a habitat with Mrs. Yellen indicating that stimulus is needed. And Jay Powell, apparently, Chance Gardner, he wants to keep his job. He's adamant also that we need stimulus. But we've talked a lot about what happens to the companies that are up the most in a period. I interviewed Mr. Gillespie 30 years ago, and he was making a fortune by buying the 1 or 2 stocks that were up the most in the year. And I've been looking for a good study of that. The last good study I found was with data from 2000. So it was 21 years out of date. So I thought that we should study it. It should be a relatively simple thing to study as to whether companies that are doing the best, the FANG companies, for example, tend to continue. Of course, you don't know that they're going to be the FANGs until they're up the most. But I offered a prize of $1,500 for a study that would unravel and try to answer the question of, does buying the companies that are up the most pay off? And I had quite a few interesting entries. And Mr. Jared, who's been a member of the spec list for a long time, he did a very, very fine study. He took a sample of 3,000 stocks that were continuous. He adjusted for survivor bias, and he found that the top decile of companies in a month went on to have a return of about 20% in the next 6 months. That was the gist of the results. Mr. Big Al did a study of this, and he looked at the companies that did the best versus the Nasdaq versus the companies that did the worst. And he was using the S&P 500 as a sample, and his results were very unusual. He found that the companies that do the worst, they're below the median, that they did better than the ones that do the best. He was using monthly data. However, both of these samples were squelched by the Nasdaq. The Nasdaq went up during the 5 years that he studies. The Nasdaq went up about 25% a year. The S&P went up about 10% a year. So Jared's study was probably the best. It's on the spec list, and I would encourage people to send me their email, and I'll, if they feel like joining a dinner party where everybody is, which has been going for 25 years, I think they'll get a lot of use out of it. They're expected to contribute as well as lurk. So amid all the brouhaha, amid all the woke things that are happening, this is usually with a woke day like this, the market goes up, and it pretended to go up. It went up to 30. It went up to the round number of 25 points away from breaking through the round number. It will do that shortly. Usually when it fails to break through a number like that, as I always say, the round number is never a penumbra. In other words, it never causes a shadow and prevents. So next time that it gets up to 38.99, it will be ready to break through. There'll be a lot of stops at 3,900. Go right through. It's only a question of time, in my opinion. So that's the gist of things. I was going to read you something from the Princeton Guide to Ecology, talking about the relationship between predators and prey. And the prey are, of course, are all the new investors, and the 6 million new investors who are undercapitalized and basing things on hope and wing and a prayer. And eventually the predators mobilize and they decimate the predators and the prey, and it will only be, and there are a lot of examples of that, and groups, predators forming groups to make themselves more efficient. Lions and the ants become forming groups, and the prey hiding and trying to develop chemical defenses so that they won't be eaten so quickly. The basic of ecology is where does a species live, what does he eat, and who eats them. So where the people who are playing with the woke, they're living with the 50,000-fold a year drift in the stock market, and even after these 5 down days in a row, and bonds at the 12-month low, they're down from 88. But the fact that crude and the inflation things are all up. The wheat was up about 6% today. We're in a partridge type of market where it's a bull market with all this pessimism and all the woke things galore. I don't think there's ever been a day there was so much. We joined the climate accord. We were going to provide money to the Confucius companies, and we're going to help go back to the Iran thing, and so everything was very woke today, and we just had a temporary decline. I've been wrong before, but things look very great to me. Okay, what else?
A quick question follow up on all of the bull market conversations. Do you ever look at any valuation metrics at all? Do valuations matter ever? Cape ratio or?
Well, I just memorialized the only study since 2000 of the companies that are performing the best. The companies that are performing the best are the ones that have the highest P, the highest return on capital, and those are the ones to buy. And
But the valuations for overall market, for the whole market in aggregate, does that ever matter or?
yes, it matters because a very good thing to look at is the relationship between the earnings price ratio, which is now about 5%, and the long-term interest rate, which is 2.2%. It's amazing that bonds stayed down today with stock market down 5 days in a row. Of course, we've had 3 red days in a row. But yeah, as long as there's a tremendous divergence between the earnings price ratio and the interest rates, is extraordinarily bullish for stocks. That's the best it's the best valuation measure at all. And what's ridiculous is when someone like Schiller talks about the 10-year PEs and whether they're high or low, as if the P 10 years ago has any relationship to the P today. Of course, and his data is all based upon S&P data when they didn't even report earnings. But it's good that people look at values without looking at interest rates, because when interest rates are 5%, the stock should be valued perhaps twice as high as when they're valued at 10%. We've covered a lot of important recurring regularities, things that are over and above whether the Nasdaq is down a few days or the S&P is down a few days, or what Janet Yellen is saying.
Mhm.
So I think it's important to concentrate on significant regularities, quantitative things based on counting. That's what I'm trying to impart to our listeners. I hope they appreciate all the ideas that one has developed and that you have sparked with your review of each market. You listed all sorts of memories and studies. I used to have about 25 colleagues working with me, and together we could do any study, and we have quantified almost everything. However, remember this principle of ever-changing cycles, that the things that worked a year ago are very unlikely to work in the future, based upon Bacon's idea about the horses becoming the trainers. The trainers are only interested in betting on their horses when they have good odds. So they purposely let the horses show bad form and come in 7th or 8th for a few things. So then when everybody is given up on the good horses, they're ready to come in again. That's how the stock market is that's how everything is in the markets. Whenever it's always ever-changing cycles. Okay,
Well, speaking of the ever-changing cycles,
yes.
if the cycle's always changing, how do you do the historical study and then reconcile that with ever-changing cycles?
I wish I knew. I wish I knew. If I knew the answer to that, I'd be a wealthy man, as Rothschild used to say. But you have to quantify the ever-changing cycles. Have to base everything on how you would do if you started from zero. But a good thing right now, I think the market is playing footsie. Everybody is concerned about whether it's up on the year. It's up 3% now, but they'll be talking about, the fact that it possibly can go down. But that's one of the cycles that when the public is most bearish, that's when the trainers bring their stocks up. That's where we are right now. Beautiful, beautiful time after 5 down days. All right, thank you.